F&C Investment Trust is intended to be a core holding for investments that are looking for exposure to growth assets. So that means we're investing in listed equity and private equity, and we do this by investing in a range of focused investment strategies that are diversified by geography and style. So, for example, we have exposure to both US value and to US growth stocks. In terms of changes that we've made, the most significant changes that we've made over the first half of the year have been firstly to reduce our gearing levels, where we raised cash. Our gearing fell from around 9.4% at the start of the year to 6.5% at the end of June, or 4.3% if you take debt at fair value. And we undertook this reduction in gearing predominantly by selling listed equity exposure. Most significant sales, those came from US large cap growth stocks. They had a really torrid first half. We sold early this year, and that follows on from quite substantial sales in 2021 from that area, and also in the second half of 2020. As well as raising cash, the proceeds from those divestments went into income stocks and cheaper value stocks in the US. We also sold out of small cap exposure in entirety, where we'd started the year with around 5 to 6% exposure. First half of 2022 has been a difficult period. Our net asset value was down by 9.6%. Share price total return was down by 11.8%, but our NAV return was ahead of the benchmark, and we're also delivering returns which are ahead of our competitors. So it's disappointing to lose value in absolute terms in terms of our NAV and shareholder total returns, but we're doing relatively well against the competition. Our portfolio returns, minus 10.8% in the first 6 months of the year, were broadly in line with benchmark, and underlying listed holdings generally saw falls in value in the first half. Essentially, equity markets were weak. They declined substantially, with many major indices falling into a bear market, which is categorized as a 20% or greater fall from recent peak. But one highlight for us was private equity performance. Private equity performed strongly in the first half of the year and was helpful to our overall returns. We also saw good returns from some of our more value-oriented holdings in absolute and relative terms, and our income stocks. In aggregate, they did decline in value, but much less than we saw from overall markets. Another area to highlight was underlying earnings. First half of the year saw underlying earnings on the trust up by 27.6% compared to the same period last year. So really good progress there. And we also plan to increase our dividend for 2022, and that will be the 52nd consecutive rise in dividends from the trust. On that point, during the first half, we did pay our third interim and final dividends for 2021, giving rise to a dividend of 12.8 pence for the full year, and that rise was ahead of inflation for the year. So during the first half, we raised cash through asset sales. We did have concerns over the economic backdrop, rising inflation and interest rate expectations we felt were likely to pressure valuations in equity markets. So we raised around about £300 million of cash in the first half of the year. Part of that rising in cash holdings was drawing down on some additional borrowings. We drew down additional borrowings which were around £140 million, including a loan out to 2061, where we pay an interest rate of 1.87%. That's a fixed rate, very, very low interest rates relative to historic levels. We did shift exposure out of expensive US large cap growth stocks. We sold out of global small cap in entirety. That was around 5% of the portfolio. We did have a long sterling position, which we cut from around £200 million at the start of the year to around £30 million by the end, and we added some more exposure to income and value-oriented stocks. One holding which has performed well recently, which we remain excited about, is AstraZeneca. This is a genuine world leader in the development of new treatments to give sufferers of many illnesses, but especially cancer patients, a brighter future. A number of existing drugs that they produce continue to be approved in a wider range of cancers and earlier in the treatment cycle. And AstraZeneca clearly did a service to the world by making no profits from its COVID vaccine, but they do have a long-acting antibody treatment, which is available on commercial terms. That's showing genuine success in protecting against COVID for immunocompromised patients or those who can't take a vaccine. So that, again, is very, very encouraging. And AstraZeneca spent many years since defeating the Pfizer bids investing in R&D to bring its pipeline to patients, and that's meant no change in dividends for many years. As key drugs continue to be successful in treating patients and the benefits of the acquisition of Alexion come through, the company has increased its dividend this year, and we do expect to see rising shareholder remuneration in the future. Another holding which has performed less well in general terms recently, which we do have a positive view on, is Ryanair. Our view is Ryanair is a quality business in a very low quality industry where new and efficient aircraft and a relentless focus by them on costs have enabled them to consistently generate high returns and cash flow in an industry where this is actually quite rare. As many shareholders will know, it's led by a colourful CEO, and it hasn't necessarily been perceived as very popular, not least by the media. But that, to some extent, is now beginning to change. We're seeing significant disruption at UK airports this summer, but Ryanair has had the least amount of cancellations, with most flights arriving at or close to being on time. And in fact, if you want to get away on holidays this year, Ryanair may be your best bet. So how's this turnaround happened? Well, a number of reasons, but unlike other airlines, they didn't lay off staff during the pandemic. Instead, they negotiated pay cuts and the return of wages to pre-COVID levels over time. Therefore, they don't have shortages of staff in general terms. They kept their pilots flying, even if it was on less hours and on their own simulators. And that meant that they had qualified pilots to fly when needed. And like everyone else, they saw a big pickup in demand from consumers desperate to get away this summer after a couple of years of COVID. But unlike others, they were actually prepared for it. So they'd worked to get to this position where they were actually well prepared and capable to deal with the increased demands placed upon them. They've got a very strong balance sheet, and that's meant they've been able to continue to take delivery of new, more efficient planes. They haven't had to sell and lease back planes on punitive terms, like many of the other European airlines who've had to actually take government money with conditions attached. And it's also meant they've been able to hedge their fuel needs, meaning that they're better protected than their peers as oil prices have risen. So overall, since COVID, we think that Ryanair, like most quality businesses, that we thought they'd emerge from the pandemic in a stronger position, and that certainly does appear to be the case, with lower capacity overall, and despite a customer base desperate to travel, fares are rising. So with more aircraft than ever before, Ryanair can take advantage of this, and this is a fleet that's quieter, uses less fuel, and emits less carbon than ever before. So we face a very challenging time in terms of the global economy and likely indeed for global markets. We are going to see a period where inflation continues to be at uncomfortably high levels, although hopefully we'll be peaking out in coming months, where interest rates are going to be heading higher, probably higher than markets currently anticipate, and where growth is actually going to be decelerating, and there's an increasing risk of recession in the US and other major developed economies as we progress through this year and into 2023. So it's a difficult backdrop, but markets have moved a long way already in terms of adjustment on pricing. Sentiment is relatively depressed. People are relatively cautious already. That said, I do think it's going to be a period where earnings now are going to be in focus. So having had a compression in valuations in the first half of this year, it is likely the focus will be on fundamentals. That's corporate margins, cash flows, earnings, and they unfortunately are going to be under some pressure. So we think it's appropriate, given this challenging backdrop, which is likely to persist, we think, for some time in terms of perhaps some stickier inflation and certainly higher interest rates than we've been used to, and less abundant liquidity. It's appropriate to remain diversified, and at this point to remain patient. So we have reduced our exposure to some of those expensive large cap growth areas of the market, tilted more towards income and value in a balanced fashion. And at the present time, with relatively modest levels of gearing and plenty of scope to increase that in due course, we'll be looking for opportunities as the market adjusts to what I think is going to be an environment of more difficult growth conditions going forward.